This program is brought to you by the Kentucky Small Business Development Center in Louisville. We provide the professional expertise, tools, and resources to help you succeed. To connect with a business coach, call 502-625-0123 or email sbdcinfo@uky.edu.
Hi, welcome everybody. I'm Dave Etkin. I'm the director here at the Louisville Center of the Kentucky Small Business Development Center Network. Glad you joined us today for another Toolkit Tuesday. Great to see everybody and hope you're having a wonderful Tuesday. It's a great day out there, not too cold, looking good. So thanks for joining. If you wouldn't mind, just because we always want to know and make sure we don't have any technical difficulties. If you look down at the bottom of your screen, you'll see a toolbar, and if you don't, just take your cursor, hover down at the bottom, it'll pop up there. And then there you'll see the chat button. If you click on the chat button, just to make sure you hear and can see us well, just say hello, tell us your name and where you're joining us from so that we know everything's working well and that you're out there listening. And let's see, we get people from all over the country, which I'm always so interested in seeing. I'm not sure how they come to us, but I'm always glad to see you. So today we got Kathy Pyrek. Glad to see you again, Kathy. Good to see you. Probably see you next week at our meeting. But and I'll say it every week. I do it. Kathy's got the coolest business story in town. One of these days I'm having you on, Kathy, because I need you to tell people this. And so there's Nikki from Huntsville, Alabama. Great. Thank you. Thanks for joining us. Carla from Richmond, Kentucky. LaGrange, Dave Sauerbach. If you need a good drive-in theater, Dave's got the one out there in LaGrange. Great place. There's one. Colleen from Corbin, welcome. Lexington. Robin, hey Robin, how are you? Thanks for joining us. Shanika from Louisville. So, man, we got a ton of people coming in today, so thanks for joining us. Always great to see everybody, and thanks for giving up your Tuesday to join us with stuff. So Kevin from Frankfurt. So we get folks from everywhere. Awesome. Thank you. So as we go through our session today, if you have any comments or questions, just put them in the chat. I'll ask them, our presenter today, and we can interrupt her or whatever. And also just a reminder, later on today, we will send you the recording of this and all the materials that we have on this to share. So don't worry about that. We'll get that to you this afternoon. So, we've been kind of on a track on our Toolkit Tuesdays about prepping up your business for the year end. And so we've got a great guest today. Sheri Radler is the owner and head accountant and a CPA and a CMA. That's a big distinction to have both. She is the head accountant at our accounting group. They are a great group that does accounting for small businesses, really makes an impact. So I wanted Sheri to come in and talk a little bit about the things you need to do to prep up for a good, successful year end, because there's nothing more disruptive trying to get ready for the tax season and the transition between one accounting period and the next. So Sheri's going to kind of walk us through what she recommends we do, and she's got a great presentation. She's a great resource, and I'm so happy she's here with us. Sheri, welcome.
Hello.
There you go. Hey.
Had to turn all the buttons on. Hello,
that's
everyone.
Right. Plenty of them.
The Zoom, the mute, the video. So welcome. And actually, let's make sure we share a screen.
Yeah, let's check that out.
Hold on a second. I'm going to say that is not being shared. Give me a second, because that Zoom taskbar is hiding from me at the moment.
Yeah, just sometimes it does that. You have to hover down at the bottom or the side or the top.
There we go. Share screen.
There we go. All right. Looks good. Looks good. So, Sheri, I'm going to just go ahead and let you continue introducing yourself. Tell us a little bit about you and your firm, and then I'm going to let you just jump in. And I'm going to step back and get out of your way so these folks can get what they need.
Okay, well, thank you. So thank everyone for joining, taking time out of your day, and proactively looking forward to where your business is and preparing for the end of the year. I'm Sheri Radler, and I am one of those CPAs that came up through the corporate environment. I worked for businesses, small businesses, global businesses, and ultimately learned how these businesses worked operationally, managerly, financially to grow their business. And one of the points of working with family and friends that had business, it just seemed that they were not using financial information in their small businesses and the same resources and functions that we were evaluating it in big business. So now we focus on working with business owners directly to use the financial information that they have in their books to help them drive decisions and improve their businesses overall. So today, we've all heard about the phrase that there are only two sure things in life. We have death and we have taxes. Well, as a business owner and for accountants, the honorable mention has to go to just wrapping up the year end. There's an awful lot that needs to happen at year end in a short frame of mind to set your business up, wrap up the year, and start it off strong for the new year. So today we're going to review what some of those items are, and we're going to discuss 4 of the main areas of the business. We're going to talk about our books and what should we be looking for in our numbers. Then we're going to move over and look at our personnel, our staffing, and what do our people need, or how do we need our people for the coming year. Regulatory and compliance, of course, what needs to be done to just keep us, we call it inside the lanes, that we are running the business in compliance with all the government and regulations that are applicable to us. And lastly, we want to look at our performance and goals. When we review the year, how did it stack up? Where are we? And of course, where do we want to go for next year? So the first stop is books analysis, and running your business without correct financial information is really the equivalent of flying blind in your financial world. And surprisingly, to me at least, is how many business owners do just that. They tell me that they don't reconcile their books every month. They don't look at their numbers. They don't realize what the cost of offering their services to their customers actually costs them, or evaluating how much money they need every single month to cover that monthly obligation, the monthly nut in their business. So understanding your numbers is really critical. Yes, I am an accountant, so this is my passion, but it really is critical. This is information you need to make. Otherwise, you are making decisions in a vacuum, and all the best intentions in the world do not necessarily always get us to where we want to go. So to start off with, we are going to check our books. We have to have an accurate picture of where are we to start our review. So determine that the information in your books and financials are correct and that you can trust those numbers that you have. So we want to take a look at the financial statements. Do we see errors? Are there negative balances where there should not be negatives on your financials? Have we duplicated revenue because rather than posting payments, we've recorded deposits into the books? Do we have all the items that we need for our business for the period have been recorded? Have we reconciled all of our accounts? As an accountant, that account reconciliation step is really the part of the process that dots the I and crosses the T, because the account reconciliation process where you reconcile your bank, credit card, and loan statement against your financials is how you identify what is in our books that has not yet cleared our bank, or what went through our bank that is not yet in our books. So until we tie that information together to provide the assurance that all the financial activity of the business is reflected in the books, is where we know that, okay, now we're getting pretty solid. Once we've reconciled that, now we want to look at those items. What have not cleared our bank? What money have we pushed through our books as payments or revenue expectations that the funds never arrived or cleared? You will want to follow up on that here at year end to research and determine what action needs to be taken. Another step we're going to look at is anything in our books that falls under an uncategorized. QuickBooks has a couple default accounts that when it does not know where to put something, it can create an uncategorized expense, an uncategorized income, uncategorized assets. But the key word is if you look at your books and you see something in there that is uncategorized, miscellaneous, or other, these are three areas I really recommend drilling a little further into, because none of those line items are actually tax return reportable items. So when we have numbers in those buckets, we must review and determine exactly where they should be correctly posted to review and improve those numbers. Let's look at our entry correction. One of the things of doing our accounts receivable reconciliations will show you and help you find possible duplicate entries in your system. So again, account reconciliation cannot be overstated there. Going into the end of the year, review your open receivables. Who has not paid you for the year? The longer a receivable remains on your books and outstanding, the lower the collectability of those funds becomes. So at the end of the year is an excellent time to make that evaluation of, do we have items that we need to write off? Are we deeming this debt to be uncollectible? Well, let's write it off, clear it off the balance sheet, off the receivables, and take it as a write-off this year and, pull it over into our books. And again, we want to review our receivables and our payables. Here at the end of the year, most businesses, you're paying taxes on your bottom line. So there's this little struggle at the end of the year. Businesses don't want to pick up a lot of revenue, but they want to do all their expenses. Well, your flip side, your partner on the other side is doing the same. They don't want to send you that invoice because it's revenue to them, but you want the expense. So review what is open and outstanding in your business and follow up on those outstanding invoices. Follow up on the uncashed checks. Make sure you have reviewed your audit of the work you have done this year and determine whether or not we have any open and outstanding invoices that we should bill for our customers to bring that revenue in this year. So once we have checked, this is where you're kind of going. This is the walkthrough to get to numbers that you really feel we now have a solid baseline of our information. And with that, the best information to really analyze your financial statements is the trinity of financial statements. You have your balance sheet, your income statement, and your cash flow. Your balance sheet provides you an illustrative look of your business encompassing the entire lifespan of what your business has been open. And it gives us position where you are currently today, assets, liability, and equity. So it gives you a very good baseline to identify where your business is. The income statement is actually a report that encompasses just a period of time. In this instance, it's typically a year, but it's also a monthly, but typically here at year end, we're going to review our income statement for the entire year. Where has our money gone? Where are we profitable? Pay attention to rising costs. Are we seeing increased costs coming up from our suppliers that is reducing our gross margin on our products? Are we experiencing supplier cost increases that is outpaying our price increases that we're rolling out to our customers? Sometimes you have to absorb that squeeze, but understanding and being aware that you are absorbing it is a proactive approach rather than reactive at the end of the year, and realizing, well, this is where we end up, and I never even realized that our suppliers were going up this high. Also a good time here at the end of the year to take inventory of your business. Of the inventory in your warehouse. Do we have anything that is obsolete, broken, damaged that needs to be written down or written off at the end of the year? The concept of lower of cost or market is something to evaluate here. And lower cost or market means what your item is valued at when you purchased it. So you purchased something for $1,000. Well, now if the market is that item is $1,200, your value of your inventory is totally acceptable because you are lower of the cost or the market. But if you turned around and flipped and realized that the product you purchased at $1,000 is now only valued at $800 on an open market, this is a time where you would evaluate whether or not we might need to write down some of the value of this inventory to bring it down to where the market forces are carrying you right now. Also evaluate your supply levels. How much inventory are you holding on hand? There are some formulas that, based on your sales and turnover, can really help you optimize the ideal level of inventory that you have, so you're not carrying a lot of money on your shelves in your warehouse. You're going to review your financial documents to determine what is your gross margin percentage and how is that affecting your profit margin, and whether or not that remains aligned with your overall business goals. There's not a lot of secret sauces in improving operations and improving our profitability, because the trinity of the financial statement also goes with the trinity of how to improve profits. We raise our prices, and that is the way you increase your profits. No more input, no more output. You are just truly raising the price of your widget. The second methodology is you actually expand and you increase your sales overall. But increased sales volume comes with the increased costs of producing or offering those services. And then, of course, the third way is reducing expenses. When times are good, often expenses can inch up because our revenue and our profits are hiding them. When we look at an economic downturn or something, a disruptor in the industry like COVID, was a time where everyone was really reviewing every charge that was going through their books to understand where their dollars were going and whether or not they needed to adapt and alter how they were working in their business. So walking away from the books analysis, do we have any questions on books that we might want to address at this point?
Nothing right now.
Okay.
Let's just move on, and then we'll keep on watching.
Okay. So once we understand our numbers and we know what our business is doing, the second place we want to turn our attention is to our human resource and our staffing. And truthfully, second only to a financial malfeasance or an issue, HR is the second most dangerous place we see clients and businesses run afoul of compliance and government. Running afoul of HR laws or payroll is definitely one of those areas that we want to be cognizant. So conducting an HR review annually is imperative to ensure that your business continues to run smoothly and efficiently. There are ever-changing employment laws, record-keeping requirements, so developing an internal process and practices to ensure that the compliance is spread equitably across all your personnel really is something that will help protect your business. So as you assess where you at from the business, and again, we've looked at it from a number perspective, but now let's look at it from our staffing perspective. Where are we currently? What are our plans for the upcoming year and even longer range plans? Do we have enough staff to meet our current needs? Do we have enough staff to meet our upcoming and projected needs of what we plan to do next year? Do we need to decrease staff, change hours, reorganize how people are working with an organization to better utilize the skills that they have? As you look into the new year, your budget wants to capture what those plans are for the coming year. And then you also have to consider, what is the ROI of hiring, the return on the investment of bringing on a new person into your team? What is the ramp up time you need for training? Can you hire them today and they are a fully functioning member of your staff tomorrow? Or is this much more often, you hire them today and it's a 90-day ramp up before they really have full ownership of that role? So as you line up your sales or your operations for next year, budgeting in the timing of bringing in that new staff as a consideration. Another consideration that we see a lot going on these days is, what is the environment in your industry? How is new technology impacting your industry and your personnel? Do we need to invest in some specialized training to keep ourselves abreast and current with the changes in our industry? So understanding not only who you have today, but who you will need tomorrow, and how what's going on in your industry can alter, are all areas to kind of bring into your thought process as you're working into your considerations. So once we know what we need and we've evaluated our position to the market, one of the questions you really need to gut check and ask yourself, are you competitive in your market? Do you remain competitive in the workforce? Have you been feeling the impact of the great resignation of 2022? Because almost everybody has. So the conscious capitalism that we are really seeing and feeling in the industry has impacted to the point where employers and consumers are paying much more attention to companies' overarching priorities. So they are very interested in supporting organizations that prioritize people over money. So treating your employees well also helps increase the positive reputation of your company within your community. We've all heard, kind of the saying, you do something right and your client will go tell 3 people, but you do something wrong and they will tell everyone they know. So understanding how your actions and treatment of your employees can ripple through the reputation and impact your company is, just again, one of those thought processes to stay in mind in your world. We pulled a few statistics, post-pandemic, almost 60% of workers rank flexible work hours as important. And I emphasize this as being flexible and not remote, because some of the statistics really were saying that it wasn't the remote that was driving the desire. It was the flexibility to be able to integrate their work and their life in a way that they felt that they had the ability to balance it. And 45% of business are citing that staggered and flexible work schedules are one of the major changes in their operations that they've either undergone or that they are looking to change currently. We have several clients that have been working this year on testing out a 4-day work week. So that kind of flexibility, just remaining open to what your team needs. You can find the ideal person, but you have to be able to get them to onboard with your company by offering what is going to attract and retain those. Beyond the flexible hours, the second most desired benefit per se to remain competitive has really stood this test of time. Prioritizing health insurance, prioritizing PTO, again, that the organization is investing back into their team as individuals beyond just their worker, helps keep that top team in your business. You want to make your business so attractive that your top people do not want to leave you. And incentives can be both monetary and non-monetary. And studies have shown that year-end incentives here at the Christmas year-end time really improve some productivity and morale. However, monetary incentives, while they increase staff engagement, are something that businesses also do need to balance against their budgets and financials. Because when you offer monetary incentives like raises or things like that, you are taking on a fixed cost that you are now agreeing to maintain moving forward. So rather than, often alternatively to raises, bonuses become discretionary bonuses, where as a business owner, you have a little more control of this was a good year versus I need to pull back a little bit on a bad year. We talked about flexible schedules, the scheduling that has shown to be incentives, these flex schedules to reduce stress levels, positively impact mental health. And it does allow businesses to actually show some improvements in productivity, less call outs, less people coming in sick, because they're able to work those needs of what needs to be done in their personal lives during business hours into that flex schedule that they have. One thing we always work with our business owners, and I am a huge advocate for, is that we really want to work to tie our incentives over into what are our company goals. We want to make sure everybody is moving in the same directions toward our overarching company goals. So offering benefits or offers that don't align to push the prime directive forward can actually be counterproductive. An example of something we're seeing, we have a client that has corporate sales goals. They work for an overarching group, and they have these big sales goals to meet. And in this client's office, they tend to meet them somewhere end of Q2. This business owner, we were laying it out a few weeks ago, but she's actually going to tie this into a contest. So the first person that meets the sales goal is going to have the option of 1 day off a week during the summer months. And the second person that reaches the sale goal will be offered a half day off a week during the summer months. So the first and second person that hits the goals has a real benefit awaiting them. The rest of the team will still be expected to hit the goals, but there's no real, prize at the end for them. So she's really approaching this as it's going to be a win for her team. It's going to gear up, some incentives, some internal competition to really push to achieve these goals. And the benefit is going to benefit her team as they get this flexibility that they will want for the summer months. So, that was a great way of her lining it up, that the incentive helped her reach the organizational goals as a whole. And then tying out our HR and payroll, we really recommend send out an email to all your clients and recommend that they review their personal information on file with the company. Do you have the correct address for their W-2s? Have they updated their beneficiaries? Do they have any changes for next year for deductions or increasing retirement contributions? This is that time of year. It's just a great time to send out and say, take a look at your information, make sure it is right. We've actually seen an instance where someone passed away, an employee passed away, and the ex-wife was still the beneficiary of the company life insurance policy, and the new family was excluded. That employee never got into the office and changed his paperwork with HR. So a nice email at the end of the year, just, hey, recommend taking a look at this. Secondly, we want to review our withholdings. Make sure all of our withholdings or any taxable fringe benefits that the company is offered. If you are offering any type of vehicle allowance, cell phones, gym allowance, all of these are taxable fringe benefits that need to be rolled into the employee's W-2 at year end. So if it's not been tracked all year, make sure you submit that information to the payroll company for the final payroll so that the W-2s are reflected accurately. Communicate with your employees about unused benefit policies, what carries over, what does not. FSAs expire at the end of the year. Those are a use them and lose them benefit. Well, health savings accounts can roll over and actually be used as a savings vehicle where people put this money in, and that will grow over time. We kind of talked about a little bit about year-end bonuses, but now is the time. If we were going to do any year-end bonuses, year-end gifting, any year-end recognition, we only have one, possibly two payrolls to the end of the year to get these dollars through. So please, now is the time to be thinking of that part. Leaving HR, this takes us to our regulatory and compliance. Rules, laws, ordinances, they all change year to year, so it can really pay to conduct a compliance audit to make sure your business is up to code. There are two questions that every business should really ask itself. What is the key compliance issues that if we violate could put us out of business or severely set us back? And the next question should be, and what do we do to make sure we don't do that? Because really, this is a little bit like a SWOT analysis, but we want to turn around and look at what we do. What are our risks? What are our weaknesses? Where do we have a weakness in our fence that if someone broke through this could really cause trouble for us? So just like a routine physical at a doctor or that annual that annual financial portfolio you have with your advisor, doing an annual business compliance really allows you to kind of identify some weaknesses and take actions to protect yourself down the road. And before you can begin to assess whether your operations are in your compliance, you really need to know what are the regulations relevant to your company and your industry. Some industries require much more compliance than others. Attorneys have IOLTA accounts, insurance companies have premium trust accounts, licensing agreements, royalties, so environmental companies. So just understanding what your business is and what the risks are. Some general documents and places to start are, well, let's first start with our taxes. Do we have our books done? Have we filed our 1099s? If you are not filing 1099s, I really advocate you take a look at this. Every business owner is required to file a 1099 for a provider that provided services in excess of $600. We have clients that go, I don't have any of those. And I'm going to promise you, you probably do. Your attorney, your accountant, your marketing company, the painter that painted the walls this year, take a look. It really is advantageous to make sure you stay compliant on the 1099s, especially this year with the new 1099K requirements. You may have heard about the $600 limit if you go through PayPal or Venmo these are coming out. So the 1099 rules have changed this year. So if you've been doing them for years and they're old hat, take the time to read up because the rules have changed this year. Of course, our 401k match, we have to, if we are doing annual match or profit sharing matches, both of those have year-end requirements for filing in the month of January. Safe harbor testing, things like that. Make sure you coordinate with your third-party administrator that your 401k paperwork has been done well. Ensure that all our health, life insurance, education reimbursements, all of those other payouts are either paid back to our employees on an accountable plan or that they are reported through payroll as a taxable fringe. Annual reports for every state that your business is registered and actively doing business with requires an annual report stating that you are active in the business. One of the first places we go to when we're talking to a new client is the Kentucky Secretary of State to see about the business's status. And surprisingly, many of these have been administratively dissolved. because the 5-minute postcard and the $15 annual fee was not paid. It was overlooked. Beyond the regular annual reports for doing business, if you can have annual charity renewals, annual licensing renewals, if you are in certain. So there are definitely annual licensing reportings and licensings to go through. If you have a physical location, have you had your fire extinguishers inspected? Have you had the health, the fire crew come in? I mean, it's a laundry list of information that does need to be done. So knowing in your industry, what is our checklist, and that once a year you pull it out and you go through and you make sure, yes, we are compliant. We have done all these things. Is again, the simplest way to stay out of trouble with the government is not to run afoul of them in the first place. It really is. Penalties and interest and fees can really rack up. So just knowing where you stand, what you need to do. Next step of this is just secure your information. Where are your statements? If you are logging into your bank, credit card, loan portals and looking at those statements, make sure you download those out of those third-party portals down into your system and cloud. Once you walk away from a payroll company, credit card company, or a bank account, close an account, you lose visibility to all of those statements. And, in the event of an audit or were you to need them, you would not have the ability and the accessibility to get them back. 2 years ago, I think it was like 2021, we had 3 clients go through a Kentucky unemployment audit where they wanted all of that information. And 2 of the clients had left their previous payroll provider. And the fact that we had that historical documentation in their records allowed them to complete this audit and get them through it with much less pain than, no audit is fun, but they did not have to turn around and go back to the state and say, I don't have that information and I no longer work with that company, and they say I cannot have it. You want to make sure you save and back up your documents. Between viruses and cybersecurity and ransomware, make sure that things are not being saved. Important information is not being saved on the C drive of any of your employees, your team's computers. Your information needs to be stored safely in the cloud, and it needs to be backed up. Backup into a separate location, a cloud. If you use QuickBooks Online and trust that all your data is in QuickBooks Online, it is. But QuickBooks Online tells you that in the event of a server going down, that they will not guarantee the retrieval of your information on a certain time frame. So we use a software or an app called Rewind for QuickBooks. And every day that just goes out there and it takes your database of information out of QuickBooks and it saves it to a secondary location. So if this file got corrupted tomorrow and we had to start over, we could import this client's entire database of QuickBooks information back in and be back up and running. So just knowing that the critical information that you need to run your business is accessible and backed up. 3 copies, 2 storage locations, and 1 of those needs to be remote or in the cloud. And that takes us to just auditing. Where are we in our business? Review your website. Is the information up to date? Have phone numbers or addresses changed? Do all the forms and the links work in your website? Cybersecurity. Do you have a cyber policy in place? Have you trained your employees on phishing schemes? If you're not yet working with an IT group, I would really highly recommend, this is a huge risk area. So to coordinate and consult with an IT group for a cyber audit, They have software that can actually come in and run on your team, your company's systems, and really isolate where some of the leakages or gaps are and help you determine some of the areas, again, that you may have weaknesses that we want to close that gap. We all hear on the news, probably weekly, about ransomware or cyber issues. And they do say they are the risk of a business attacked by a cyber group, surviving it and staying in business more than 2 years afterwards really drops. So it's like having a cybersecurity attack is, really impactful for a business. And then, of course, access. Do the necessary and people have access to the programs and softwares in your system? Do you have segregations of duties in place? Click into your softwares and look at who your users are. Quite often you will find old employees that are no longer with you still have active users on your software. So one, you're probably paying that user license. But second, these folks may have backdoors into your system that you're not aware that as they left, you never disengage them from a MailChimp or a Canva or a QuickBooks or, something like that. So just knowing who has access to your information is truly a great safety feature to conduct here at year end and understand. Going into the fourth section, do we have any questions at this point?
Yeah, we do have a few.
Okay.
So Diane had asked, are there any sites on the lower of cost of market calculations you can share?
So lower cost of market is an evaluatory. So one of the areas is you are going to the internet to vet it. What is the item I have here? And if I were to go back out and rebuy it. So that is, there's not a lot of websites where you put in your item and it tells you your lower cost or market, as much as you are going back out and reshopping to replace this item. If you had to replace this item into your inventory, is the higher or lower? And that is the first baseline of that.
Okay. She also had a question. Can you say the 3-2-1 item again?
Oh, okay. So 3 sources of documentations, 2 backups, and 1 remote. I want to say that was it. Oh, that was like that. Yes. So 3 items, 2 locations, and 1 of those being a backup.
Okay. Michelle, hi Michelle. What are your thoughts on solo 401ks versus just making annual IRA contributions?
Depending on how much you're open to contributing. A lot of people will start at a solo 401k, but the annual contribution level is less than what is available. Excuse me. A lot of people start as an IRA and then step up to a solo 401k because the annual contribution limit increases on a 401k.
Okay. And then David asked, what typical vendors that we pay do not require 1099s, i.e. utilities, incorporated business, Walmart?
Great question. It is a great question. First of all, when we talk about 1099s, the 1099 is actually an informational return. This is not a tax item. And what it is, this came about many, many years ago. The IRS is looking for, not to put too fine of a point on it, they're looking for money that is paid that can potentially be unreported to the IRS. Think under the table concept. So they are focused on services that are provided often by small businesses. So the first rule is if they are an incorporation, you do not have to send a 1099 to an incorporation. If they are a public traded company on the NASDAQ and S&P, the Amazons, the Hiltons, no, these are companies that have full accounting teams and businesses, actively invoicing clients, accepting payments, and with a full scope of books that the IRS has a significant level of confidence in. So the push is really in small businesses, potentially unreported. We do not go to, we are not sending 1099s to restaurants, to hotels, to Amazons, to Targets, anyone big like this. You are sending 1099s, or you would question our accounting group, George Jones Painting System. I have a small social media marketing company over here that works with me. So when you are thinking smaller businesses, the best rule of thumb is when you start a business, a new relationship with a vendor, request their W-9 as part of just your vendor package. We need your vendor 9 on file for our accounting department. A W-9 allows them to check the box of what their taxable entity is. They are an LLC, they are a partnership, they are a corporation. If they check corporation, they are automatically excluded. So 1099s really go out to your sole proprietors, your LLCs, your partnerships, things like that. They will always go to your attorney. Doesn't matter how they are a corporation or not. Attorneys always get a 1099. Don't know what the IRS says about that, but apparently attorneys are people they keep an eye on.
Okay, I think that's it for now. We'll catch the rest of the questions at the end. So we'll just have to go ahead.
Okay. So we're going into the last group, and this is our performance and goals. As you prepare for the business review, I'm not sure if anyone has heard of Simon Sinek. He is an author, a motivational speaker, but he has a book for business owners that says start with why. And the premise of the book is that he is counseling business owners to stay focused on the why. Why did you set out to do what you do? What was that overarching, this is my passion, this is my why? And one of the goals he says in the book is the goal is to not win every battle, but to outlast our competition. And truthfully, for some of you guys that have been around in business for a while, you can probably look around and see that you've had some competitors in your space. They've come, but they've gone out almost as fast. Longevity really helps in developing your business, your reputation in your community. As a business owner myself, that was part of it. When I first started, I teased. It was like, well, what makes Sheri on the street corner different than Jenny on a block as an accountant? And, it really was, developing the reputation, getting known, building the business. So if you're constantly asking your question of why are we doing what you're doing, you're trying to ensure that the business is value-led and that you're making decisions value-based, that what you're going for every day is, again, aligning with what your targets were. We have 3 main groups that we have to invest in our business. We have our employees, we have our customers, and we have our shareholders. All of them have aligned but competing desires and needs. But the truth of it is, you as the business owner, what is your why? That's the part to kind of, at this point at the year end, we want to stop and assess, how are we lining up to that? And running a business really involves keeping track of a lot of information, from quarterly reports to people talking in the hallways. I'm famous. You can talk to me in a hallway and I'll get back to my office and I'll be like, what did we just talk about? Just because my mind is engaged on something else. And so a ball can whiff by you. So it's only natural that things do slip past, but stopping and doing this evaluation and reviewing your business, the SWOT analysis as a business review is really helpful. So just start with asking yourself 6 questions. What did we set out to do this year? What was our goals this year? Were we growing? Were we expanding? What was, when we walked into this year, what did we plan for? What were the challenges that we faced? What did we learn from them? What were the mistakes we made? Where did we miss an opportunity that, now looking back, if we'd got zigged left instead of right, we would have ended up in a different place? the goal is we want to determine how do we repeat our successes and avoid our mistakes for the next year. So look back a little bit. Examine the fundamentals of your business. Every business has a core product or service that you are offering to your client. So now let's re-examine here at year end of how this is aligning to what our client needs. Do we need to pivot? Do we need to go vertical, horizontal? Is there a way to shift what we're doing? Is the fundamental of our why and what we're bringing to the market still aligned with what the market is wanting itself? Because if we do not stay aligned with where our customer is, we will find that we've lost touch with them and they've moved on to a different direction. One of the best parts of the review is the financial evaluation. It takes time for a small business to really start earning a profit, but documenting your progress along the way is essential. How is our cash flow altered and changed? How is our cost base changed? What are we seeing on our financial growth? Even sometimes the numbers don't look like a lot, but when you look at them percentage wise and you see that you've done 10, 20, 30% growth, those numbers are really showing, that you are achieving those goals. Then, of course, we want to revise our data, take a look back at what we've done. What were the red flags to our protocols or hard to track successes? Where did we get surprised? Right now, we've been in between COVID and this past year of rising prices, are you too heavily reliant on a single customer? And when they got shut down for COVID, you impacted the ripple effect. Are the products that are coming in for your world, did you get part of the supply chain shortfall this year? Because you always bought from one guy and this guy, he got backed up and you didn't have anyone else in your portfolio to turn to. For your critical infrastructure needs of what you need to run your business and provide your service, you may have your preferred vendor, but please always have a secondary and a third that you're kind of cultivating. You never put all your eggs in one basket from a supplier standpoint. Part of when you started your business, you probably evaluated and studied the market and the industry that you wanted to go into when you designed your business plan. Much of what you went into likely holds true. But let's take a stop and study it. Are the customer needs still what you started out with? How are economic changes impacting it? What about competitor status? You may have been an early adopter into an industry, but is your industry filling up with other competitors? So what does that landscape environment look like to you? And then, of course, part of the annual review is reflecting on the past, but the important part is how we use this to evaluate a plan for a future. Once you have a solid grasp of how your business has evolved over the past 12 months, it's worth it to really consider developing some new strategies for things like, bottom line, what are our realistic financial goals for next year? And if we say we're going to grow our bottom line here, well, now we have to talk about where up in this body are we going to do it? Is it raising prices, selling more, or reducing costs? Remember, there's only 3 answers to that question. New strategy. What about upgrades? Talk to your team. What resources do they need to increase their productivity? Just because we've always done it this way, there are, apps, software, technology. Is there a way to build a better mousetrap for what we want? And then, of course, always remember that not all of our goals are financial goals. Some of our goals are the non-financial, those value-driven goals. And so we want to find a way of weaving those into our business model. So at the end of the year, when you do next year's annual review, not only have you accomplished and you've grown towards your financial and monetary goals, but you've also grown to your why. This is why we do it. This is what our purpose is. And again, we always want to just kind of keep the world walking in tandem, hopefully in that direction. So when you've done this evaluation, did you meet your goals? How'd you measure up to your own internal expectations? If you met your goals, why? What was the driving factor? You know, when during the year did you accomplish them? Were they too low goals and you met them so early that you should have challenged yourself by increasing them? Were smaller goals, because when you have this big goal and you break it down, were the steps of this project and goal done on time? And if you didn't meet your goals, again, what was the driving factor for not meeting it? Was it something that was unanticipated? No one anticipated a COVID shutting down businesses. Every budget we did in fall of 2019 got blown out of the water in 2020. You know, it's like they weren't worth the piece of paper they were written on very quickly. So sometimes it's an external force that you cannot control, but sometimes you will look into, and it's like, well, we didn't meet our goal, but we were very close. And had we done this, we could have. So just understanding where you fell on that goal metric is really important. Of course, we want short and long-term goals, and goals should be, they're SMART goals. They're specific, they're measurable, they're achievable, they're relevant, and they're time sensitive. We have plotted out this goal in this plan. And then setting a course of action. What are our goals for this upcoming year? I read a book a couple years ago that really helped me with goal setting. It is called The 12-Week Year. And the premise of it is that everyone, you know, that starts off with a goal at 12-month goal. Well, the first quarter of the year, it's like, oh, I got plenty of time to reach that goal. We'll get to it. Mid-year, you start feeling a little pressure of, I got to get started on that goal. Third quarter of the year, it's like, well, it's almost too late to do the goal. And by fourth quarter, you're like, yeah, we'll do it next year. So what they've done is they really kind of adopt a mindset of breaking out your goals into 12-week years, which 12 weeks is a quarter, but breaking down these overarching goals into quarterly and breaking them down into smaller bites to help you achieve those goals and keep moving on them, that they don't just become a goal you set aside and you revisit them next year. And the last step of preparing for the new year is once we have our goals and we've looked at where our business has been, we've assessed who we have on our staff and what our needs are for next. We've looked at our compliance and maybe some changes we need to do to shore up some weak spots. So we want to draft a budget for the new year. We want to determine what are our plans for the new year that we can measure against financially. Coordinate with your tax group, determine what your current tax rate is and what is your bracket. Are you anticipating those rates and brackets increasing or decreasing over next year? As your income goes up, you will move to a higher tax bracket. So sometimes there are decisions that are more advantageous to do now before you're at a higher tax bracket. Well, contrasted, sometimes the decisions are wait till you are in a higher tax bracket because you get more of a benefit. Evaluate that strategy with your tax person, because as an accountant that may work on your business, we only see a piece of your pie. We see your business. Your tax group should see the entire pie. They know your spouse's income and your investments and your portfolios and your other, you know, they have the entire picture. So you really want a tax group that will work with you, evaluate that picture, and have a conversation with you. At the end of Q3, going into October, one of the advice we give our clients is take the third quarter financial package we provide you and go have a sit down with your tax group now. Because any changes they want to recommend for 2022, we still can do. We can pay out distributions, we can pay out bonuses, we can change your tax position. Waiting until next year when you're working with them on your taxes and they're like, well, if only, or we could have changed, they can only give you directions for the future. And Q3 is the time, or excuse me, and Q4 is the time to work with your group on this year's taxes to really decide whether or not there are modifications they recommend. And that is really just a fast, quick breakdown of the various areas of business that we work with our clients, making sure we have worked with them and touched on these 4 points as they go into year end.
Thank you, Sheri. That was great.
Thank you.
And we'll leave your slide up here for a bit while we talk a little bit more. So that's Sheri's contact info. She's a great person to know. So I recommend that you reach out to her, especially this time of year. If you're looking to make a change or need some advice, Sheri's available for you. We got a couple other questions that popped up. So Sharon asked about if you would go over the SMART goaling again. And I like what you said about the 12-week year too. I remember reading that book myself and I've totally forgot about it. So maybe you can kind of mesh those two things together, maybe go into a little bit more detail on how you would use those two ideas together.
Okay. So the 12-week year, like I said, was just a concept of taking what our goals and breaking them down to bite-sized pieces as a way of not getting so busy. And we, as a business owner, there is always so much to focus on today that needs to be done. Tell me you're not always batting out balls, you're putting out fires, you're dealing with just today's stuff. That as a business owner, you actually have to remember to step back often enough to make sure we stay on target, big direction. So the 12-week year is just a way of really introducing the mindset of breaking these big goals down to chunks that are a little more bite-sized and relatable. And then the goals themselves, I really like this and I've been playing with it myself, but they call SMART goals because we can all set a goal. I want to, I don't know, come up with a goal. Give me a goal, but okay. But if it's just a random goal, I want to grow my business 20% next year. That's a goal. But now let's break it down. Well, specifically, how are we going to grow our business 20%? How are we going to measure it? And at what points are we going to spot check to see how we're doing? Is 20% even an achievable goal in our industry? Is it a reasonable goal? Is it relevant to us? And is it time sensitive? Did we give it? Do I want to just raise my revenue 20% or do I want to raise my revenue 20% this year? So the time factor part of it. So that part of it really helps in laying out goals to me. And we've really introduced it to our team over the last couple of years because it's like, well, I want to do this. And with our business owners, and it's like, okay, well, when do you want to do it? Well, I don't know. I want to retire. Well, when do you want to retire? I don't know. Next year, 2 years, 5 years, because once we know your goal, we can reverse engineer how to get there.
Mm-hmm. Well,
so, yes.
let me just get a little bit more granular with this. So how do you track, measure, and like quantify your progress? I mean, do you integrate with tasks in Outlook? Do you just stick it up on a wall, or what do you do?
I actually, personally, I have an Excel spreadsheet that goes out 24 months. So there's a column for every month, and down the left, give you an example. We wanted to implement a software. So it was like in August of this year, we were going to demo the software and decide yay or nay. So kind of think of a Gantt chart is how I'm running this Excel sheet.
Okay.
So I said in August we were going to evaluate the software. In September we were going to yay or nay. In October we were going to implement it. In November we were going to go live, and we were going to run it through the end of the year to decide, pass or fail kind of thing. So, but when we started off early in the year, it was, wouldn't it be great if there was a software that would track 1099s for us? It was like, okay, well, let's go find that software. But it really was how, when, where are we going to do it?
Yeah. Okay.
That was one of ours this year. I've seen goals whiteboard it. I have a client, his goals are the whiteboard in his office, and it is the top band of his whiteboard is just his like bullet point goals. And over the year, as he reaches them, he just crosses through them. So for him, it's that visualization of and he says it when I'm sitting in my office and I'm just I look up and it's like, okay, yeah, that's my goal. Okay, and it kind of, he looks at it as, yeah, that's why I'm doing it. So, I mean, just two different ways.
Okay, that was good. David asks, so are you advising small businesses should have separate accountants versus tax preparers?
Yes. And most of your tax preparers will actually tell you it is not that your tax preparer, and I came from public accounting. I came up through corporate, but I spent several years in public accounting here in Louisville with one of the big firms. And the truth is, and ask your tax guy, most tax preparers take the numbers you provide them and they use them to compile your tax returns. It is you as the business owner's responsibility to provide them correct information. Most CPAs are not going through your books to determine if your books are right or wrong. They are taking your information and they are going with it. And this was when I went into the CPA firm. I went in to build this client accounting service for a CPA firm. And it was one of those conversations, like I would look at the books and it's like, how are you doing this tax return? Their balance sheet is all wrong. And the answer really was, it's the numbers the clients gave us. And the client said, these are our results we want you to work with. But talk to your tax groups. Some tax groups actually will go through and scrub your books. And that's part of why they say their fees are so high, because they're spending so much time having to get your books in good shape to use for tax returns. We work with several tax firms in here town, and we, just give you an example. I have a partner at one tax firm. Client comes to him, he looks at the books and he's either like, I can do something with this, or you need to go talk to Sheri's group and come back when your books are straight. Because that is it. At tax time, these guys don't have the time to scrutinize your day-to-day activity to determine if your books are right.
Right. Great. I think let's see. So Georgette says, you mentioned a formula on helping optimize inventory.
There is, it is days inventory. If you Google it, there's a days inventory on
day
hand.
Sales and inventory.
Yes, day sales for it. It's a formula that I don't remember off the top of my head, but the metric is numerator is, this is how much inventory we have divided by how much we sell a month, is how many days or months worth of inventory we have on our shelves.
Right.
And with inventory degrading, going obsolete, you want to find that sweet spot, because if you've tied up too much money, a liquidity into inventory, and you're like, I'm going to sell this all next year, you've invested probably too much money into the inventory on your shelves. So it is inventory divided by sales, day sales inventory on hand.
Yeah. Yeah, there's a bunch of those ratios. So Georgette, I would just Google that and you'll find it. Yeah.
Yeah, there's quick ratios, liquidity ratios, what is how fast can I turn these assets to cash if I have to? The quick ratio, liquidity ratio, inventory ratio. receivables, how long does it take you to collect your money? Your AR ratio are 4 that we look at a lot.
Yeah.
Because that's just it. How long does it take them to get their money? How much money do they have on hand? You know, they're the important ones to us. How long, you know, how much money do they have on hand that they can pay their bills before they have to invest? The liquidity ratio.
Right.
So yes.
So you'll be able to help everybody with those things, right?
Absolutely. Me and the great team at our accounting, because this is not a one-man show.
Yeah. That's all the questions we have. And this has been really great. Also, if you look in the chat, we've put in Sheri's guide that has a lot of the comprehensive information that Sheri shared with you today. You can just download that. And if you don't get a chance to download that, we'll send it to you a little bit later on this afternoon as well, so that you can have it with our recording and the slides and everything. So Sheri, thank you so much for joining us today. This has been great. I know I'm going to take away a few things to work and use in my business. So I really appreciate that. Well,
thank you for having me. Really enjoyed it.
Yeah. So thanks everybody for joining us up for another Toolkit Tuesday. So enjoy your Tuesday today and enjoy the sunshine. And we'll see you next week on another Toolkit Tuesday. Bye, everybody.
Bye, everyone.